Government budgeting is the process by which the government plans, allocates, and monitors the public fund. The process involves estimating revenues from taxes, fees, borrowings, and planning the expenditures required to achieve policy objectives within a fixed fiscal period, generally 1 year. Government budgeting in India. The government budgeting in India is a comprehensive exercise undertaken by both the central and the state levels. For the discussion, the focus is on the Union Budget, that is the annual financial statement of the central government. Union Budget of India. The Constitution of India has the following provisions when it comes to the Union Budget. According to Article 112 of the Indian Constitution, the Union Budget refers to the annual financial statement of the central government. This statement provides details of estimated receipts and expenditures for the financial year. The Union Budget can be subdivided into three categories: budget estimate, projections for the upcoming fiscal year; revised estimate, updated estimate for the current fiscal year; provisional, actuals, receipts and expenditures of the previous fiscal year. Union Budget of India. Important facts. The Union Budget is presented in the Parliament on the 1st February every year since 2017-18. Before this, the budget was always presented in the last week of February. The railway budget, earlier presented separately since 1924, was merged with the general budget in 2017-18. The nodal agency managing the Union Budget is the Budget Division of Department of Economic Affairs, Ministry of Finance. Government budgeting stages in India. Government budgeting in India is divided into 4 phases: budget formulation, preparation of estimates of receipt and expenditure; budget enactment, legislative approval through finance bill and appropriation bill; budget execution, collection of revenues and spending as per approvals; legislative review, post-budget audits and scrutiny by Parliament. Procedure of Union Budget enactment. The Union Budget is passed in the Parliament by the following procedure. The President fixes the date of the budget presentation. The budget is laid down in the Lok Sabha by the Union Finance Minister, followed by laying it before the Rajya Sabha. The budget is then put up for debate on basis of principles and priorities without voting. The standing committees examine demands for grants in detail and submit reports, voting on demands for grants. Lok Sabha only. Lok Sabha votes on expenditure demands, converting them into grants. Rajya Sabha can only discuss, not vote. Cut motions. Policy cut motion. Reduce demand to ₹1 policy disapproval. Economic cut motion. Reduce demand by a specific amount. Suggest savings. Token cut motion. Reduce demand by ₹100. Raise a grievance. The appropriation bill is passed after grants are approved. This bill authorizes withdrawals from the Consolidated Fund of India. The Finance Bill legislates tax proposals and revenue measures. Finally, with the presidential assent to Appropriation and Finance Act, the budget is finally enforceable. Government budget components. The government budget is subdivided into 2 main components: revenue budget and capital budget. Revenue budget. The revenue budget details the government's revenue receipt and revenue expenditure. Revenue receipt. Income received by government that is not repayable. Tax revenue include direct tax, example income tax, corporation tax; indirect taxes, example custom duties, excise duties, service tax, GST; other direct taxes, wealth tax, gift tax, etc. Non-tax revenue. Interest received on loans, dividends and profits from the government investment, fees and service charges. Spectrum revenue, grants from foreign countries, institutions. Revenue expenditure. Revenue expenditure neither creates assets nor generates future returns. Example: salaries, pensions, subsidies, interest payments, grant to states, UT, and daily functioning of government departments. Capital receipt. Funds that either create liabilities or reduce assets. Debt creating. Fresh loans and borrowings. Non-debt creating recovery of loans. Disinvestment proceeds. Capital expenditure. Capital expenditure is the spending that leads to creation of assets or investment. Example: infrastructure, roads, school, hospitals. Equity in PSUs, loans to state or union territories, and repayment of loan principal. Budget types. The Union Budget is of the following type: balanced budget, receipt equal to expenditure, rare in practice; surplus budget, receipt greater than expenditure, used to control inflation; deficit budget, expenditure greater than receipt, used during recession depression. Budget deficits. The deficits in budget is of the following types. Budget deficit equal to total expenditure minus total receipt, rarely used now. Revenue deficit equal to revenue expenditure minus revenue receipt, indicates non-asset spending. Effective revenue deficit equal to revenue deficit minus grants for capital assets introduced in 2012-13. Fiscal deficit equal to total expenditure minus revenue receipt plus non-debt capital receipt. Primary deficit equal to fiscal deficit minus interest payment. Monetized deficit equal to borrowing from RBI plus cash drawdown leads to increase in money supply. Government budgeting types. Government budgeting is of the following types. Line item budgeting. List expenditures by categories. Performance budgeting. Links spending to measurable performance. Zero-based budgeting. Introduced in 1987-88 and every program reviewed afresh from zero each year. Outcome budgeting. Introduced in 2005 and consolidated in 2017-18, it focuses on result achieved rather than inputs. Gender budgeting. Introduced in 2005-6, it examines budgets from a gender perspective to promote equality.